Okay, so welcome back to the desk. We're going to move on now to our third gatekeeping process, which is monitoring price action. So we've had a look at commitment of traders reports, which give us a very good indication in terms of market positioning and timing in the currency markets. We've looked at technical analysis. Price action is part of this overall process, part of the gatekeeping process, and we monitor price action on a weekly basis as part of a watch list. And a watch list is basically a list of all the fundamental ideas that we want to actually put on. So nothing ends up on the watch list unless we've been through the entire idea generation process and we've got to a point where we actually want to put the position on. And it's a good audit of keeping all of these ideas in one place so we can stay on top of them and monitor the price action in conjunction with technicals and commitment of traders reports. Now, something that you have to get used to before we go over to the computer screen is that in terms of deploying capital, there's just no rules. You'll go over to the computer screen and Chris is going to show you how to build your watch list and monitor price action correctly in conjunction with TA and in conjunction with commitment of traders reports. But you have to get used to a principle here that in terms of deploying capital, there's no hard and fast rules that apply to all situations. So you can't go down to a bookstore and buy a book called How to Deploy Capital to Publicly Traded Assets in All Situations. It just doesn't exist. So the best we can do is deploy common sense as part of an overall systematic process. And this is one of the big retail trader errors. Retail traders are always looking for the rule book, always looking for the manual that gives them instructions on what to do in every scenario. So looking always for the easy route. It's subjective and it's discretionary to the particular situation that you're looking at as part of the overall systematic process and what your portfolio looks like at any one moment in time. Because you're going to be adding a new trade into your portfolio. And if it doesn't add up that it should be there at all, then the idea generation process that you've been through, the gatekeeping process that you're going through now, it means that the idea coming through that's now turning into a trade is invalidated. So deploying capital becomes a problem. So you can see how there is no rule book. You have to look at this in a subjective way. So with price action, the way you've got to look at it is we're looking at the price changes on our ideas that we really want to put on a weekly basis in conjunction with commitments of traders reports and technical analysis. Now, what shows up in commitments of traders reports and what shows up in technical analysis is likely to be verified by the price action. However, technical analysis and COT reports follow the price itself. So price action itself is an indication of what is likely to be playing out in commitment of traders and what's likely to be playing out in technical analysis, because they follow the price itself. So when we're monitoring price action, we have to look at price as a leading indicator itself. So for example, when we're looking at Aussie dollar, US dollar as our example, the price itself is a leading indicator of indicators that follow. So let's go over to the computer screen. Keep that principle in mind. There are no rules. The best thing we can do is deploy common sense and be the gatekeeper to our own capital and try to stop ourselves doing stupid things. So again, entering bad trades full stop, or entering good ideas at the wrong time and then they turn into bad trades instead of turning into good trades. Let's go over to the computer screen and I'll see you at the end of the video for a conclusion.
In this video, we're going to go through a watchlist example spreadsheet. So a watchlist is essentially a monitoring and gatekeeping tool that we use before our ideas go into a live portfolio. So the way that this watchlist actually works is that it allows you to monitor price action of your ideas by looking at current prices and recording current prices of the assets that you're considering and updating those on a weekly basis. So you can see here that at the top of the spreadsheet, at the top of the watch list, we have a portion devoted to equities and equity spread positions. Now that's all actually covered in our professional trading masterclass course, and what we're going to do here is actually consider the currency section in a bit more detail. So I just want to go through that now and just show you what we're looking at on an overall basis in this spreadsheet. So within the currency section, it's split into two subsections. The currency pairs that we're looking to go long, that we have fundamental predispositions to for going long with, and the same for short. So we've got those listed there, and as well as that, we record the entry price, so that's the price at which those assets were when we put them into this watch list. And then to the right of that, we've got another column for current price, so that's updated, say, on a weekly basis manually by yourselves. And what we can do from that is in column T here, we've got calculations for overall returns from when we put these positions, these ideas into the watch list to the current price, so the latest update that we've put in manually for the current price. And that gives you overall returns. So for our long section here, obviously the positive returns are in our favor, and for the short section, the negative returns are in our favor. And then beyond that, we've got weekly updates of returns, and those are generated by some formulas that we will look at in a little bit more detail later. It's largely formula driven, and that just allows us to monitor and keep track of weekly price action. So the first thing to understand here is that we create a watch list in order to service our target gross exposure. So in this example, as we've already seen, we've got some equity spread positions and some currency ideas, and there's space for some commodities and other asset classes as well at the bottom of the sheet. So we've got roughly 15 equity spread ideas in the watch list and around 10 currency pair ideas as well. Now 7 of those have actually been opened and put into a live portfolio. So they've been taken off the watch list, they're no longer recorded, the details for those, and they've been put into a live portfolio. So let's consider a multi-asset portfolio example, a bit like we've got here. So let's say we have $25,000 on margin and a maximum gross exposure of $200,000. You might then have a maximum single position size limit of $20,000. So a single position being a single equity stock, currency pair, or any other asset. And what that would mean is that you need at least 10 of those positions, so 10 times $20,000 if they're at full capacity, in order to reach your gross exposure limit of $200,000. And in reality, you're actually probably going to need a few more than that, a few more than 10 in the portfolio, because not all of them will run at full capacity at the position size limit. You'll have some that are likely to be starter positions or half positions, and the reason they have less capital allocated to them is that they've not yet proved themselves enough in terms of performance within the real portfolio to warrant a full position size. And there's benefits of having starter positions in there. It allows you some flexibility and options as the price action comes through as well in the real portfolio, and we discuss that briefly later on as well. So if we consider another portfolio, a currency-only portfolio with the same margin and the same gross exposure limit, so margin of $25,000 and gross exposure limit of $200,000, you might then have approximately a 33% position size limit in any one currency pair, which would then equate to $66.6 thousand for any one of those positions. And that essentially amounts to 3 trade ideas, 3 trades running at full capacity, i.e. their position limit, in order to get to your gross exposure limit in that currency portfolio. But in order to actually service that correctly, you're going to need a lot more ideas than that on the watch list, and probably at least 3 times the ideas, so that you can actually service your portfolio with high quality ideas on a revolving basis consistently. So there'll be 9 ideas, 9 currency pairs from our tradable set that we look at in this video series, and there's a note of that in this spreadsheet, and you'll get this spreadsheet in the download section of this video as well, so you can have a look and remind yourself of that. So the first thing that the watch list is used for is to service the portfolio with lots of good ideas, and clearly not all of those trades that we actually end up putting on are going to come good, so that actually makes it even more important to use the watch list to maintain and service the portfolio with lots of good fresh ideas all the time on a continual basis, and that will help us make sure that our portfolio is always very high quality. I want to bring it back briefly to what I was discussing earlier in a multi-asset class portfolio as well, in that we talked a bit about higher position size, single position limits in currencies than equities. So in currencies, it was about 33% of the maximum gross exposure limit, and in equities, it was, or the multi-asset class portfolio, it was a bit less. And generally, for asset class with less volatility like currencies compared to equities, the position size limits may be a bit higher. So another way to work back from a $200,000 portfolio, multi-asset portfolio, or equities and currencies portfolio, is to split that into 2, with 100,000 gross exposure devoted to equities and $100,000 gross exposure devoted to currencies. And then what you might have is a position limit size of $10,000 for your equities, which would give you 10 positions, 10 equity positions in that $100,000 gross exposure portfolio, and 3 FX pairs with the same 33% limit that we discussed earlier, which would equate to $33.3 thousand in the $100,000 maximum exposure currency side of the entire portfolio. But the thing to remember is that no matter what assets you're looking at, as a general rule of thumb, you probably want around 3 times the amount of full position trades that equate to your gross exposure limit as ideas in the watch list, to make sure that your portfolio is continuously serviced with potential trades. So an idea ends up on the watch list if it's fundamentally a good idea. So we looked at the Aussie dollar US dollar example previously in the video series, and the fundamentals indicated going short that Aussie dollar US dollar pair. However, the conclusion that we have generally come to by looking at the commitment of traders reports is that the timing might be slightly off. So if we look at that position in our watch list here, it's in the short portion of our currency positions. So we've got here short pairs Aussie dollar US dollar, we've got our entry price, our current price, and we've got a few weeks of price action to look at, and total price return as well from when we entered this onto the watch list to now. And what you can see is, first of all, there is positive price action, which in this case, because it's a short position, is not in our favor. Second of all, and that's largely down to the last month or two with the Aussie dollar US dollar pair, and second of all, the price action is a little bit choppy as we go through the weeks. So overall, it actually backs up what the commitment of traders report said, and means that the timing is probably slightly off. So the key purposes of the watch list is to actually avoid bad ideas becoming bad trades, and also to better time good ideas, so good ideas become good trades. And there's always going to be currency pairs going wrong on the watch list, and that's exactly why we have a watch list in the first place. It's part of the gatekeeping process, and if it's gone against us in the watch list, then we've actually saved money by not putting the position on in our portfolio. So this also helps us make sure that we get into good ideas with better timing, so we don't get stopped out when the pair goes in the direction that we thought, because the fundamentals are now starting to play out. So on the one side, we don't get into bad trades because the bad price action doesn't allow us to, the gatekeeping process. And on the other side, hopefully we time the good ideas a bit better so that we don't get stopped out and miss their potential upside when the fundamentals start to come into play. So getting in at the right time actually consists of looking at the commitment of traders report and the technical analysis, aligning with our fundamental idea so that's how we generated the idea in the first place, and the price action being in our favor in the watch list, and consistent as well. So that's what I was talking about here with the Aussie dollar US dollar example. Not only do we want the price action to be in our favor, which it wasn't overall since we put it on the watch list, but we also want some consistency in our favor. So that basically would mean then that a trend is developing, and that will show up in our technical analysis and commitment of traders reports as well. So the watch list and price action monitoring is actually a head check exercise in conjunction with the commitment of traders reports and our technical analysis. And the gatekeeping process kind of allows you to spoil the portfolio with high quality ideas, and we try to get the stars to align, if you like, in that your fundamental predispositions are backed up by commitment of traders reports, technical analysis, and then the gatekeeping process that we're looking at here. So there's no hard and fast rules for deploying capital. You can't go to Amazon or your local bookstore and buy a book called "This is how you deploy capital and manage risk in all scenarios." But the best we can sort of do is apply common sense and use a systematic process to help us along the way. So every entry into a fundamentally good idea that has our gatekeeping lined up must be taken on its own individual merits and in the context of your portfolio at any point in time. So like I said, there's no hard and fast rules to exactly how much capital you should allocate to your different positions. But if you follow the principles that we're talking about here of not committing capital to losing trades on the watch list, and also not committing capital to price action that's too choppy. And ideally what we want to see is consistent, stable price action in our favor. So those trades are almost presenting themselves to you, waving their hand saying, "Hello, Mr. Trader, I'm ready for you to trade me now." So you're fundamentally long or short the currency pair or asset. Then the commitment of trader reports show you timing opportunity. The technical analysis assessment agrees and indicates a trend is beginning or back on, for example. And finally, the watch list or gatekeeping process that we're discussing here agrees with positive or price action in your favor overall and in the last 2 to 6 weeks, and it's not too choppy. So this type of overall output may warrant a starter or full size position, but again, there's no hard and fast rules for that. That's subjective and dependent on your portfolio at the time and the individual merits of the position you're looking at. So later on, what we're going to do in the video series is look at risk management. So we'll look at stop losses and targets, and we'll bring in concepts of hard stop losses and soft targets, meaning we enter every trade with a predefined downside and an open-ended upside. And you'll see that we cut losers and add to winners. And what sometimes happens is you'll have starter positions which will give you choices. So if you commit less than the full capacity of capital allocated, so the maximum position size, to a trade and start with a starter position, then it gives you options in terms of if the timing is slightly off, then we can actually add to the position if it goes against us in the short term, and we can also comfortably add to the position if there's any sort of technical breakouts for long positions or technical breakdowns for shorts. So once you've watched the winning and losing trades video in the risk management section later in the video series, make sure you come back and rewatch this video to actually deepen your understanding of what we've been looking at so far. Now I want to briefly show you how to update this spreadsheet on a weekly basis and talk through some of the mechanics of how it all works. So we're going to continue by looking at the currency section, and there's a few processes that we need to get used to here. So the first thing I want to point out before we begin going through those processes is that you're most likely going to start with a watch list that's blank, which will look quite similar to these rows here at the bottom with these commodities asset classes. So you're going to have a load of formulas in these weekly return cells and blank information in most other parts. And that's fine. It will make more sense when we go through these processes that I'm going to talk to you about now. Just in case you're starting to get really confused already with what this formula looks like up here, I wouldn't worry too much about that. What you need to know, it will become clearer when we go through the processes, but what you need to know about it is just that it's kind of an automated way to calculate the next weekly return. And I'll show you how to apply these formulas across different processes as we go through. But you don't need to understand every single part of that formula there. You just need to know that it calculates the next weekly return when we use the processes to update the watch list. So the first process to look at is updating a new week. So we're going to look at that now with the Aussie dollar, US dollar. So what we're going to show is basically manually updating the current price, because that will change when we're updating that. That's a manual entry, and that will be something that you gather yourself from the internet, probably a site like investing.com/currencies, which is what we've used before earlier in the video series, or any other website that you're familiar with for currency data. So that needs to be updated, and obviously we need a new weekly return then as well. So let's go through this in stages. So the first stage of updating a new week is simply to take the last week available, so that's week 8, select that cell, press Ctrl C, right click within that cell, go to paste and paste special and paste as values. So we're copying and pasting that return as a value. You'll see the formula bar now shows that, and it's not a formula. The next thing we want to do is update the current price. So I'm just going to assume that the price has now moved to 0.8, and in order to see the week 9 return and for it to be calculated using this formula here, we need to update the weeks column to 9, and you'll see that that populates there, the week 9 cell of that asset. So that's all you need to do for updating a new week. Next, let's look at adding a new row. So if we scroll to the left of the spreadsheet and we add a new row at the bottom of the short pairs, so if I select row 41 and right click on that and then go to insert, that's inserted a new row, and we'll put in a short example as GBP versus USD. Entry price might be 1.55. This is just an example to go through to show you how it works, not using real data. So again, entry price 1.55, and in the first case scenario, the weeks will be 0, and we won't have a current price, or the current price will be the entry price. And we need to copy down also the overall return in column T from the cell above. So you'll see that's done there. That's now calculating the return between the current price and the entry price. Next, what we need to do is get the formulas in for all of these weeks, so week 1 to 12. And the formulas will only show values as we update, like the process that we just went through. So what I've done is created some template formulas at the top of the spreadsheet here. So from cell V3 to AG3, if you just select all of those and press Ctrl C, that copies that section, and then Ctrl V to paste it down here, then that's going to give us all the formulas that we need to calculate these weekly returns. So it's copied the border as well. So to get rid of that, all you need to do is select those cells, and in the Home tab on the ribbon, just go to No Border here in the Borders drop-down menu. Right, so let's start with a week 1 example. So let's say in week 1, the position moved to 1.56. We don't actually need in week 1 to actually copy and paste this as a value 0%, because nothing's been recorded yet, it's not moving. So let's make the first price that we look at 1.56, so the new current price. So, and now the week is 1. So now that data is correct. We've got week 1 return the same as the total return, which is 0.65%, because the current spread is 1.56 versus 1.55, and we've recorded the number of weeks, which is 1. And then the same process as we did before to update a new week. All you would do is copy and paste this as a value. Then you would update the current price, 1.57, let's say, and the week to 2, 0.56%, week 2, 0.64%, and so on. You could do that all the way across. The third and final process that we're going to look at here is extending your watch list beyond 12 weeks. So what these formulas do is actually reference this row here, so row 6, it's actually in the equities part of the spreadsheet, and it's just got the week numbers 1 to 12 there. So what we can do is, say if we're updating these two formulas here, so we want to go to week 13 for USD, JPY, USD, SCK. All we would do is select the week 12 formulas, so that's cell AG 28 and 29, and then copy those across by clicking and dragging the bottom right hand corner little black box, copying those formulas across. You'll see that they now say value, which is an error. The reason they're having an error is because they're trying to reference the next cell up here, but there is no data there, and it needs to be 13 for week 13. So now it says that. These are now going to be like any other formula up to week 12 for the other assets that we've looked at. And for good measure, you can label this within the currency section, week 13, if you like. So that's how you extend your watch list beyond 12 weeks as well. So now you know how to best manage and update this watch list. It's important to remember the key points that we've actually talked about so far. So the first one is capital should only be allocated if the stars are aligned. So if the fundamentals show you that you should be long or short, the commitment of traders report agrees, technical analysis agrees, and the watch lists all agree together. And remember, with the watch list, it's about not allocating capital to losing trades going in the opposite direction to that which you want. So price action that isn't in your favor, and also don't allocate capital to trades that are too choppy in their price action as well. The second key point to take away is the watch list is actually there to help service the portfolio with a high quantity of high quality ideas. Thirdly, and more importantly, the watch list is there to stop us committing to bad trades and also mistiming good trades, which we talked about earlier in the video, and that's a key point. Finally, there isn't any hard rules that you can apply to allocate capital in all scenarios. It's going to depend on discretion in terms of risk tolerance, individual position merits, and the portfolio situation that you have. But with some common sense and applying these principles that we've talked about in this video, it will be able to substantially help you along the way.
Okay, so welcome back to the desk. What you picked up there from Chris is really important in terms of the overall gatekeeping process. As outlined earlier, price action is important, and as important, if not more important, than TA and COP reports, because the price is the leading indicator. Now, Chris did mention a few things there in terms of the ideal situation in terms of deploying capital. So the ideal situation, which is important to get a handle on, is obviously price action that's going in your favor and price action that's stable. In scenarios like this, as long as we have TA and COT starting to confirm this nice trend beginning, then deploying capital becomes fairly straightforward, because we're going to get very clearly a green signal and even possibly amber, depending on how comfortable you are in deploying capital to that specific situation. Now, this is the principle that we really have to get a handle on here, which is there are no rules in terms of deploying capital. You know, as we pointed out earlier, and Chris on the computer screen as well, you can't go out there and get a rule book or a manual which says in public assets, this is how you deploy capital in all scenarios. This is not available, it doesn't exist. Retail traders are always looking for the manual and the instructions on exactly how to do things. Unfortunately, it doesn't exist, it's subjective to the situation itself, the individual situation, and in the context of your overall portfolio. The price action that we have to watch out for is the negative and choppy price action. This is where a lot of subjectivity comes in, because it's not an ideal situation, but in the background we have a fundamental predisposition, and we believe that the fundamentals are correct. So in this scenario, this is exactly where it comes in terms of trying to time good ideas better and trying to stay out of bad ideas altogether. Because if you have a fundamental predisposition and you put the idea on the watch list before it becomes an actual trade and you're committing capital to it, and it goes against you, well, the obvious question is, am I right? Is my fundamental predisposition actually right? Because the more it goes against you, the more you're going to question it naturally. However, if it goes against you, this can actually be a good thing sometimes, because it means if it is actually a good idea and it can end up being a good trade, then this is now an opportunity to get in at a much better time, and we've saved ourselves money. But it could quite as easily be a bad idea. Remember this phrase, there's nothing you don't know that the market doesn't already know, because maybe we're late to the trade, maybe we're late to the party, and we're going to be the idiot that puts the trade on too late. And when it goes against when the market goes against us, we're the people who end up holding the baby and having the bad position, and that's what we want to try and avoid. So When it goes against us on the watch list, we have to obviously ask the question, the obvious question, are we late to the trade? And if we believe that there's a possibility that we are, then it's going to be a red on the traffic light system. But if we still believe this is a fundamentally great idea and it stacks up, then we can commit a small amount of capital. We're going to move on to risk management next. And what you're going to realize is that the gatekeeping process itself is a risk management tool. Because in the gatekeeping process, we're trying to stop ourselves doing stupid things in terms of deploying capital. So it's very, very easy when we have a fundamental predisposition. It goes onto our watch list as a long or a short. We see the COP reports in our favor, we see TA in our favor, we see price action in our favor, and we're getting this nice trend confirmed. We can commit capital. That's all very straightforward. It's when you get negative and choppy price action, the technicals are against you slightly, and the COP reports are neither here nor there. When you have this, it's subjective, it's an amber on the traffic light system. And one of the options is always just to have a starter position. Because if you have the negative choppy price action, the technicals going slightly against you, and the COP reports going slightly against you, if you commit some capital and then it goes in your favor, that's a great feeling. But if you don't commit any capital and then it goes in your favor, you've missed the opportunity to actually save yourself money. And you can always add to the position if you have the starter position and then it goes in your favor, and then you're making money, which is obviously the objective. So that's one of the worst things in the world that we've actually talked about previously, which is you put an idea on, it goes against you, you get stopped out, and then it goes in your favor massively. Well, what if you have a watch list, you put a good idea on it, it's not yet a good trade, it goes against you on the watch list, and then you decide not to put anything on, and then it goes in your favor massively. Well, that's just as bad a feeling because you've missed that opportunity to save money. So there is subjectivity to this, and you've just got to throw this idea out the window that there's a rule book where you have to do this in all scenarios, do this here, do this there, do this there. It doesn't exist, so get used to it. The best you can do is deploy common sense and try to save yourself money. That's what it's there for. So in an ideal scenario, you want positive and stable price action. If you get that, then you're confirmed. You've got a good trend and you can deploy capital. You should feel quite comfortable about doing that and deploying capital. When it goes against you, common sense prevails. It's a timing mechanism. And when you commit capital in these situations, you always have to have in the back of your mind that it should never be a full position, it should be a starter position, and even with a starter position, the market is against me. Maybe something's going wrong here, but I'll take a little position so I'm in the game. By taking that approach, you're timing good ideas better, and you're staying out of bad trades altogether, or you're going into positions with the right position size for the information that you've got in the market. And position sizing is something we're going to look at a little bit later in risk management. So this idea that the gatekeeping process is actually a precursor to risk management, or a risk management process in itself, is how you need to look at it. It's you looking after your capital before it becomes live in the market. Now, we looked at our example, Aussie dollar, US dollar, that we've looked throughout the idea generation process and through the COP reports and through technical analysis and now through price action. And we've come to a very obvious conclusion. Although our idea stacks up fundamentally and we want to be short the Aussie dollar, US dollar exchange rate based on our endo and exo processes and analysis, our timing that we've looked at in the gatekeeping process is off. So in the COP reports, Net positioning is at extreme shorts, so historical extreme shorts, and it's likely that we're going to get a rally based on historical evidence. The TA, the conclusion there is that we're probably looking at around the mid-80s before we start really considering putting a decent sized position on to begin with. The price action is choppy and against us. So the Aussie dollar is a perfect example, and this is why we're using it in the video series for various reasons, of a fundamental predisposition that doesn't work out in terms of timing. So this gives you a very good example of how to go through the overall process. So we've been through the gatekeeping process, that supplements the idea generation process. Now we're going to move on to the risk management phase, and this is where things get a little bit interesting and a little bit fun. I'll see you on the other side in the next video.